Hey folks, I'm back. It's been a while. I took a couple weeks away because I really had to reorient myself. Full disclosure, I ended up putting a down position because I expected the markets to go down on October 1st because of Trump tariffs. Wasn't the case. So I ended up losing probably about 50K or so maybe 20% of my portfolio. And that really wrecked me psychologically. But what ended up happening is I the reason I did that was actually based on pretty good fundamentals. A lot of signals were looking like they were bearish. And when we see more tariffs coming into play right now, which is why the markets dipped so much, I actually feel like that was a good justification for why I did what I did, but I should have set my risk controls higher. So, this is a great reminder for other folks out there that even if you want to make a bet, always remember that you might be wrong and what's the cost of being wrong. Because you do want to make sure that even if your timing is off and you decide, oh man, it went up right after I got out. Don't feel bad and don't try to revenge trade because you can end up losing even more. That's actually not what happened. I did end up revenge trading a little bit, but then it helped because it ended up making me some more money back. But in general, it's highly risky because if you're not in a good headspace, there's a really high chance that you're going to be thinking emotionally, you're going to be doing things that are really dumb, and you'll be easily manipulated by the markets. My dad has a saying, if you don't control yourself, then something or someone else will control you. So try to have good discipline, try to meditate, and try to make sure that you're very objective about the positions that you take and the losses that you make. Usually, I'm okay with losing 10 or 20% of my full portfolio. I was greedy in this case and I tried to hold out for longer, which is why the contract expiration date was getting closer and closer. And so then I was like, oh man, I'm not going to be a coward. I'm not going to sell. I'm going to try to diamond hands these buy puts. But unfortunately, let's see, it was about right here, yeah, October 1st, right here. I was still holding on to them, and they expired October 6th. So it was really good that I got out and cut my losses because otherwise I would have lost probably another 30 or 40K right there. And even though I was technically kind of right, I knew the markets were kind of frothy, and I knew that there was um, a lot of foam and things could pop really quickly, like they did between Thursday and Friday here. Being early is unfortunately similar to being wrong if you don't have the proper insurance to be wrong. So it makes sense that the markets are dropping today. Trump announced that he's threatening more tariffs on China. So again, it's the whole tariffs conversation that keeps scaring everybody. I was generally right about three things. I was right about gold. So gold has been shooting up like crazy. I got out around 190 because I thought, oh man, that's getting too high. Then it shoots up over here to 228, and then it's crashed back down to what, like 194 or whatever. I'm thinking that actually it might be okay to get back into gold at this point. Again, this is not investment advice, this is just me thinking, because there are a lot of international banks that are all holding gold instead of US dollars now. So that's something that I think is really interesting. I actually made a decent amount of money back the past couple of weeks that I've been off, but I wanted to take a bit of time away, reflect, and think about my mistakes to try and make sure that I can get back on the horse with a more level head and make sure that I'm not trying to go too aggressively on dumb decisions. So today I wanted to talk about what I promised to talk about last time, which are basically these 7 or 8 different stocks that I thought were kind of interesting. I'm going to breeze through these and I'm going to tell you to go look these up yourself because I think that you need to make sure that you're not being spoon-fed random information. I could tell you lots of positive things, but then not say anything about the negatives, right? So try to be careful about any information that you consume and do your own research. But I'm just going to quickly go through these and explain my rationale for them. So ASTS, space, they are specifically focused on satellites. Satellites have a lot of implications with networks, specifically when we want to talk about things like phone networks, so data plans. I see a lot of opportunity there because everybody wants satellites. Military wants satellites. So there's a lot of other space companies out there that are trying to do dumb things like mining asteroids or going to Mars. I don't think that those are actually economically viable, but satellites I see as a big business. So ASTS, definitely an interesting one to follow. Robinhood joined the SP 500. They introduced sports betting. They take money from retailers like me who are really dumb and who make emotional trades. I'm super bullish on them. I use them all the time, and every single time I put in options contract, if I don't do a limit order that's at a reasonably low price, then they'll take me for whatever price that I choose that's inefficient relative to the lowest actual price. So for example, if you want to buy a stock and the stock says it's trading at $102, then you could put in an order for, let's say, $102. Or maybe you're trying to ask for a little bit lower, so you ask for $101. But in reality, the only people who are selling it are selling at selling it at like maybe there's actually people who are willing to sell it at $100. So then Robinhood and all these hedge funds and group like that, they make money from that difference. So they buy it for, let's say, $99 because they don't tell you, and then they sell it to you for $102. But now nobody else wants to buy it for $102. Everybody else wants to buy it for $99 or $100. So you instantly lose $2 from that. That's a 2%. So it's those kinds of inefficiencies that Robinhood partners with hedge funds in order to make money off of retail traders like us. Some of the ways you can mitigate that are to use other platforms or to just try to limit your orders. Or, frankly, I think that people are sometimes penny wise, pound foolish. Robinhood has a fantastic UI that makes everything so easy to access. So if you're a long-term trader, which I think the majority of people should be, you shouldn't be trying to compete against high-frequency traders who have billions of dollars of computation, infrastructure, and resources. Instead, you should try to focus as a retail trader on longer term horizons, things that you think are going to stably rise and grow, or at the very least, things that have momentum in multi-day plays. Because statistically, it's a lot harder to account for all the possibilities over a week rather than just one day. Within a single day, you generally know there's a limited amount of things that could happen. Within 1 week, within 1 month, who knows? And this is why predicting weather is actually really hard as well. You can predict the next couple days pretty accurately, next week maybe, but then once you get out to a month or 2 months, you can be totally wrong. And that's why you have to keep recalculating those things. So try to be a long-term investor. Try not to be emotional about your trades. QuantumScape. So this one is frankly, what I've heard from a lot of people is it's very interesting because they are focused on lithium metal batteries, so for electric cars. Now, that implies companies like Tesla, companies who are focused on the electric EV, the EV space. I see some decent potential for them. I think that they're definitely limited by how much electric vehicles are going to continue to grow, because here's the other thing. If people decide that gas cars are actually more efficient, and which generally speaking from greenhouse gas emissions perspective and also from energy consumption perspective and stuff like that, I think the ideal would be hybrid. So if you look at Toyota, I don't think they've gone with a full electric car yet. They're mostly just focused on really efficient gas cars. And that's generally the way to go if you want the best bang for buck. That's why Toyota is really up there. But if you are willing to take that bet on the future of electric cars, you think that the aesthetics are nice, you think that it's going to be more efficient in the long run, I actually do think that that kind of makes sense. When you have electricity that's being passed through the grid rather than physical trucks carrying a bunch of oil to a physical location and then waiting for people to come to that location to get it. I think that's the whole supply chain there is less efficient, but I think you might want to look into that a little bit more. The way I treat this, it's more of a momentum hype stock right now. And when you look at what they're doing, you'd probably want to focus in on what are the contracts they're closing, what are the next upcoming big uh, closed deals that they're getting. Those are probably going to be the biggest price movers. SoFi, similarly, I think that this is probably more of a meme stock than anything. It's got a decent amount of value to it, but I think that there's a bunch of people who are coming in hyping it up a lot. I see SoFi as, to give you some background, it's basically insurance, if I recall correctly. Um, yeah, let's just it's a one of those neobanks. So it's, yeah, banking, lending money and stuff like that. What's cool is that they're basically like a digital bank, and their competitors are going to be probably other kinds of digital banks and stuff like that. If you believe that that's where the industry is going, which, it might be, and if you believe that they have the technology to be able to make more money than traditional banks, yeah, you might want to consider them. One of the biggest sources of income for banks, well, you can look into it, but there are multiple different sources, from retailers specifically, from like average everyday Joes. There's going to be things like the credit card interest rates that you get, the fees for um, ATM transactions, withdrawals, for minimum balance, all these different kinds of fees that you introduce. But then there's other aspects too. Like, for example, you could sell the debt to different groups. So you can bundle a bunch of people's debt, and then you can sell those off. You could do insurance stuff, lots of different avenues. So I'm excited to see in the long run what SoFi does. And I think that they have potential, but it's just so much to follow. I'm pretty overwhelmed by all of it, and I wouldn't want to be super bullish on it unless I knew exactly what their plan is in the long run, how they expect to get there. Generally speaking, their earnings have been pretty good and they're on the up and up. So they definitely seem like a group to look out for. Now, Tempest AI is biotech. Well, it's more like health tech. So they've got AI in the name. You can imagine um, uh, they're definitely not one of those companies that bangs a couple sticks together. Well, actually, maybe they're secretly that. I mean, there's plenty of people who slap AI on their company, and then you find out that AI doesn't stand for artificial intelligence. It actually stands for actually Indians. So this company is probably getting a massive boost from the whole AI hype, but I think that there are potentially some applications here. I have some amount of background within the health biotech space, so I do understand that it is a company that's potentially going to see some progress, but you have to look at what their earnings are like. And earnings are actually, like they're doing relatively well there. So, yeah, might want to follow that, see where they're going next, and understand what partnerships they're expanding out to. I personally think that health tech is probably going to be one of those areas that can benefit a lot from deregularization. So, deregulation. So, when there's too many rules, too many laws that get in the way, like data privacy and stuff like that, on one hand, people be really terrified of every company having their data and exploiting and stuff like that. But listen, just honestly, everybody already has their data. It's just a matter of who's going to make money from that and who ends up getting the most benefit. If you make the data more accessible, more available, then it lowers the barrier to entry for a lot of these companies that are trying to do good. So companies who want to try to find the cures to things like cancer and all that stuff, they need access to more data, and they need access to a lot of different people's experiences so that they understand, oh, okay, so this is how cancer can grow, or this is like where it can be found. This is all the different ways we can use to address it. So technology is really helpful for that when you don't have a lot of data, but it actually would accelerate our work if we just nationalized people's health data. So that's a little bit of politics or my own personal opinions there. Yeah, I'll try to keep that limited. UPS is going down a lot here because, unfortunately, again, Trump tariffs. So they generate a decent amount of money from shipping and things like that. If you have less packages and less shipping, then you're not going to make as much money. But Pelosi actually invests in them sometime, I think maybe in August. But you can see they haven't exactly been going that far, doing that well lately, probably because of all the tariffs involved. Now, originally, I was going to say I think these guys are doing pretty well on the dividend. Look at that. It's almost an 8% dividend. It's probably why the stock keeps dropping, because you basically sent down the price of the stock to pay out on the dividend side. But if you are a long-term investor, you would probably not want to invest in something like this, because the dividend counts as income, first of all. And if you want to invest in stocks, then you'd probably prefer to invest in something where you can hold it for more than a year, and then you can sell it for long-term tax gains. So I think the long-term tax rate is about 15%. If you are in a higher income bracket, then stuff like this is just going to end up being taxed away. So you might as well just put your money towards stocks that seem more promising, might deliver like 20% return or something. Now, speaking of 20% return, you can see HIMS has been doing pretty well this year. They've actually been expanding away from just personal hygiene products into prescription medication. That, I think, is why they're starting to go up a lot, because when you talk about prescriptions and medication, one of the things that might come to mind is weight loss drugs, which have gotten really popular. Now, are they going to be able to close those contracts? Do they have weight loss drugs? Let's look it up. HIMS weight loss drugs. Yeah, so they do have personalized weight loss treatments. They have a bunch of different techniques and stuff like that. They do have GLP-1 injections online too. Great. So they are probably going up because of that. These GLP-1 drugs, for those who don't know, are basically these big weight loss drugs that have gone really popular. You might hear them as Ozempic, Wegovy. Novo Nordisk is the main manufacturer, and then Eli Lilly copied them and is making a lot in the US. Now, HIMS has a great subscription-based model. If they're selling a whole bunch of other stuff already, then they probably would be able to benefit from tons of additional products that they can push onto people with the same subscriptions, or with additional add-ons and things like that. I definitely see potential there, but unfortunately, I think, again, you see a lot of hypesters. So people will keep pumping up the price like crazy, and then it'll keep crashing back a little bit. So just be careful of that. Try to get in on a lower price if you are trying to go long, because I think that you have to be careful with a lot of the hypesters and a lot of the foamy markets right now, where everything's getting pushed up. And of course, one of my favorites, gold miners, 3x leverage. So I am very bullish on gold. Right now, my entire IRA is in gold. So it's really, I think, one of the safest places, because it's going to be inflation resistant. When you look at Polymarket, you can see the Fed decision in October is most likely with 92% of consensus and $60 million betting on this, saying that it's probably going to be a 25 basis point cut, which means interest rates are going to go down, inflation is going to go up, price of assets like stocks, real estate, all that stuff is going to go up. So yeah, I would say be careful out there, folks. There's definitely money to be made, because the stock market is really volatile, and if you're careful, you can probably get in on good prices for stuff. But also, don't be surprised if things continue to go down, or if they shoot up all of a sudden, or if they're going side to side like crazy. We are currently living in some very uncertain times, what with tariffs, inflation, unemployment rate going up, and all of this stuff going on. It's a lot of chaos out there. Stay safe, try to stay healthy, try to stay well emotionally balanced, and take care of yourselves. All right, I hope to see you all in the next video. Thanks for sticking.